Today, I want to try to conquer the ever-elusive mystery of escrow accounts. By definition, an escrow account is an arrangement whereby a third party receives and disperses funds for the primary transacting parties as per the terms of a contract between those parties. This is why you'll often hear a title company referred to as an escrow company, because they receive and disperse funds on behalf of the buyer, the seller, the bank, etc. So your mortgage escrow account is an account by which you deposit funds each month along with your monthly payment to cover the taxes and the insurance. The portion of the payment that is earmarked for taxes and insurance is deposited into this separate escrow account and held there until the annual payment is due. For most Texas counties, the bank is going to pay your property taxes in December, and your annual insurance premium is typically due on the anniversary of your home purchase, unless you change insurance during the policy term. When you're escrowing, your monthly payment will consist of the principal and interest to repay the loan, as well as 1/12 of the annual property taxes and insurance premiums. In addition to the monthly premiums that you will pay, your lender will require you to keep a reserve in the escrow account in case of any changes to those premiums from year to year. As an example, and we'll assume there's no PMI for the sake of simplicity here, let's say that your mortgage payment is $3,000 per month. Your annual property taxes are $8,000 and your annual insurance premium is $2,000 a year. 1/12 of those property taxes and insurance would equate to $833.33 a month. So your principal, interest, taxes, and insurance payment, often referred to as PITI, would be $3,833.33. The $833.33 would be deposited into that separate escrow account and held there until the taxes and insurance come due. It's important to remember that while your P&I payment, the actual loan repayment terms, never change on a fixed rate mortgage, the taxes and the insurance can and probably will fluctuate on an annual basis. So this means your lender will be doing an escrow account analysis each year to determine whether your escrow account is properly funded. So for the example mentioned previously, let's say that your escrow account was established in June. In June, we would use last year's property taxes to establish your escrow account. Let's say when that tax bill comes in December, your property taxes are actually $9,000. Your escrow account would still pay the $9,000 in order to keep you current. However, this would result in your escrow account having a $1,000 shortage. Typically, escrow shortages are allowed to be repaid over a period of time, usually as much as 12 months. But wait, now your property taxes are $9,000 instead of $8,000. So that escrow payment actually would need to go up to cover the whole $9,000 annual property taxes as well as the $2,000 insurance. So now, even before the shortage, your escrow payment goes from $833.33 to $916.67. In addition, you're going to have to pay the $83.33 back from last year. So now your total payment, including principal, interest, taxes, insurance, and the escrow shortage repayment, goes to $4,000 a month. $3,000 to cover principal and interest, as well as $1,000 to cover future taxes and insurance and the escrow shortage. Once you've repaid the escrow shortage over the 12 months, then your payment would be reduced by the $83.33 for a total new payment of $39.16.67. Another really important aspect is how they affect your dollars due on closing day. Remember, we have to collect anything that's due right now at closing from you. So your first year's insurance premium is collected at closing. In addition, if you're closing in June, we would have to collect 6 months of taxes to cover all of the months from January 1st through your closing date. And remember that both the taxes and insurance require a 2-month reserve. So you're actually paying the full year's premium of interest at closing plus 2 months. Then you're also paying 6 months of taxes at closing plus 2 months. And then one more caveat, a June closing would mean your first payment's not due until August 1st. So we'd have to collect a 3rd month of reserves to cover that month where no payment is due from you. You can subtract $4,125 as a prorated tax credit from the seller on this, because the seller is of course responsible for the property taxes from January 1st of the closing year through your closing date. So the total amount due from you at closing to establish your escrow account and pay any taxes or insurance that are due now would be $5,125.01. If you or someone you know has recently received an escrow account analysis from the lender and you have no idea how to interpret it, feel free to reach out. I'm always happy to help. Same for if you need help establishing how much money you're going to need on closing day. Thanks for watching.